Good afternoon, everybody. Thank you for joining us again for our latest tax update webinar. Following the usual format as we normally do, over the next 45 minutes or so, we'll go through different topical areas of tax that we feel will be of interest to you all. I'll be looking at business taxes. My colleague Vicky will look at private client matters, and poor Clarke will finish off the session talking about the latest news in tax disputes and resolution. As always, please feel free to ask questions as we go along. We'll pick them up at the end, but if you use the Q&A function on Zoom in the little bar at the top, please use that to ask any questions. The webinar is being recorded. So you'll be able to access it again at a later date, shortly after we've finished today. It'll be uploaded onto our website and also onto our YouTube channel. Okay, so we'll start off then with business taxes. And the two topics I wanted to just talk through today with you is a capital allowances update, and then I wanted to have a chat around property businesses and some of the relevant and pertinent issues around that. As far as capital allowances is concerned, a few things to have a think about. First of all, the super deduction, which has been in for a couple of years, March 21, that ended on the 31st of March 2023. So any expenditure incurred after the 31st of March 2023 no longer qualifies for the super deduction. Now, if you have an accounting period that straddles the 31st of March 2023, what you have to do in terms of the super deduction percentage is pro rata that. So as you'll remember, the super deduction, when it was first introduced, gave an enhancement of 130% against the cost of the qualifying asset. Because of the changing rate of corporation tax from 1st of April 23 and the fact that the super deduction ends on 31st of March, if you have an accounting period, and here we use an example of the 31st of December 23, the rate of the super deduction is actually 107.4% and not 130%. And the way we work that out is we have the total period of 365 days and pro rata it depending upon the number of days falling pre 31st of March 23. And if you think about this, the way this will work out is that because the rate of corporation tax increases from the 1st of April 23 for all but the small companies, the actual effective rate of tax relief you'll get is broadly the same as before. Now, it's not all bad news in that the super deduction is being replaced by what's called full expensing. I spoke about this a couple of webinars ago when it was first announced. And this is a 100% first year allowance for main pool expenditure and a 50% first year allowance for special rate pool expenditure. So this will apply now for expenditure or qualifying expenditure from the 1st of April 23. Now, in many ways, it's similar to the super deduction. There are lots of conditions that broadly have carried across. So it applies to companies only. It's only new and unused assets which qualify for full expensing. You get balancing charges on disposals, like you do with the super deduction. And there are similar exclusions as well, main ones being cars and used or second-hand assets. Now, the tax relief is very similar to the super deduction. Again, this is a function of the increase in corporation tax rate. So for the super deduction, it was 130% with the tax rate at 19% gave you an effective rate of 24.7. With full expensing, you get 100% first-year allowances, but the corporation tax rate for large companies is 25%. Now, of course, there will be a different analysis if companies are paying corporation tax still at the small companies rate or in the at the marginal rate. Now, one thing to remember is that if you're disposing of an asset upon which the super deduction has been claimed, this will result in a balancing charge. So even though the super deduction itself has finished, you do still need to track assets upon which the super deduction was originally claimed, because on a sale, the proceeds will need to come into account as a balancing charge. Now, the annual investment allowance, of course, is still around as well, and that's been, I use the word fixed very loosely because nothing is permanent or fixed in the tax world, but for the foreseeable future, that is now £1 million per annum. So given the choice between full expensing or the annual investment allowance, which way would you turn typically? Well, for unincorporated businesses, of course, there's no choice. They don't qualify for full expensing, and so you would always look at using the annual investment allowance for those businesses. Otherwise, generally speaking, the annual investment allowance is still preferred, particularly where capital expenditure is less than £1 million, mainly because you don't have this balancing charge on a disposal. Of course, the pool value decreases as a result of sale proceeds coming in, but that works its way out over a period of time rather than being a balancing charge in the event in the period of sale. There's also less admin around tracking assets because you don't need to bring in a balancing charge. Used and second-hand assets, you can't claim full expensing relief on those anyway, so you'd look at the AIA, and likewise integral features, which do qualify for AIA, but would only qualify for 50% first-year allowance under the full expensing rules. So a few things to think about from that perspective. Just want to move on next to a completely different area, but one which is, I think, very relevant, very topical, taxation of private landlords. It's something that we come across a lot, and I'm sure a lot of you will too. Now, as you're probably aware, for interest on residential property portfolios, tax relief is now only given at the basic rate at 20%. But that's not the end of the story, because how the relief is given can impact the taxpayer in an unfavourable way, and it could mean that the actual overall impact for them is higher than just losing out on higher rate tax relief. And the reason for this is the way it's calculated. I'll go for an example shortly. Well, in essence, what happens is you're taxed on the rental income before the interest cost, and then you get relief at 20% for those interest costs against the tax liability. So if, for example, the pre-interest profit pushes the individual into a higher rate tax band over, say, £50,000 or over £100,000, that could have a detrimental effect, both in terms of the tax rate, but also things such as the high income child benefit charge. So here's an example just showing how this would work in practice. If, say, we have a property business that has rental income of £100,000, we have deductible costs of £20,000, but also we've got interest cost of £30,000. So looking at the property business as a whole, it makes a net profit of £50,000. However, the way the calculation works is that you only get the initial deduction for the non-interest costs, and have to take into account the personal allowance. You end up with a tax liability of just over 19,000 in this example. Then you get your credit for the interest cost. So you end up with a net income of £36,000. Now the profit is only £50,000 overall. So the actual effective rate of income tax on that is around about 26.8%, whereas what we're looking at here is otherwise a basic rate taxpayer. Now this is a very simplified example. Of course, in most cases, or in lots of cases, there will be other income to be taken into account as well, but it gives you a feel as to what impact the interest restriction can have. And in some cases, if you've got highly leveraged businesses, highly leveraged property businesses with additional or high rate taxpayers, you can end up where the actual rental profit is absorbed completely by the income tax liability. So moving on from interest relief for property businesses, another aspect that is worth mentioning and reminding people of is where we have replacement of domestic items. So this is a specific tax relief where certain goods inside the property are replaced by the landlord. So you can get relief for the replacement of things like furniture, furnishings, kitchenware, etc. Now, the important point here is the deduction is only for the replacement of those assets, not for the initial purchase. The initial purchase won't attract any tax relief at all. And the replacement asset must be substantially the same as the item it is replacing. And we'll come on to this just below. As usual with any type of tax relief for business expenditure, the expenditure must be wholly and exclusively for the purposes of the property business. So an example here, if a landlord replaces a sofa with a sofa bed, the deduction is only allowed for the cost of replacing an item similar to the original. So for example, if a new sofa costs £500, but the sofa bed costs £650, tax relief would only be available on the £500 because that's the like-for-like replacement. Now, there is a bit of a carve-out here. If the replacement is a reasonable modern equivalent of the asset that it's replacing, then the full replacement cost will be allowable. An example of that is if, say, wooden windows were replaced with UPVC windows. In general terms, that should qualify for the replacement of domestic items. And what happens then if the property business makes a loss? Now, property losses are quite restrictive in terms of how they can be utilised. The default position is that the losses are automatically carried forward, and they're carried forward indefinitely and set off against future property income, so long as the property business is continuing. And they're used against the first available profits in future periods. What this can mean sometimes is that the personal allowance is wasted in those subsequent periods due to the losses being carried forward. You can't restrict them to preserve the personal allowance. And also, this is the important one really, you can't get sideways loss relief against other non-property income. Now, there is a bit of an exception if the loss arises from capital allowances, but that will rarely occur, certainly with residential property portfolios. Might be more scope there with commercial property portfolios. And what about capital losses? Well, they're automatically set off against other capital gains arising in the same tax year. And that can be any gain, not just property-related gains, even if that means the CGT and exemption is wasted. So again, you can't restrict that set-off. However, any unused capital losses that are carried forward and set off against future capital gains, you can restrict that carried forward amount to preserve the CGT annual exemption. Of course, that is becoming less relevant now with the reduction in the annual exemption down to £6,000 this year and £3,000 next year. And one thing just to remind you of there, in terms of capital gains, of course, you do have the 60-day reporting and payment window for any capital gains tax arising on most sales of residential properties. Now, finally, I just wanted to talk about incorporation of a property business. Now, this is something that's a bit of a hot topic. It's got more relevance in recent years, mainly due to the interest restriction, because companies aren't subject to that. And it is possible to transfer properties to a limited company. Now, that will be a disposal for both capital gains tax and stamp duty land tax purposes at market value. However, from a capital gains tax point of view, you can get incorporation relief in the right circumstances. And this means that any gain in the property portfolio is rolled over against the shares that are issued in the recipient company. Now, one of the conditions for that relief is that you need to be transferring a business. And this can be difficult with a property portfolio in terms of being able to determine that you do have a business being undertaken and not just a collection of assets. There was a tax case in recent years, the Ramsey case. There is the other Ramsey case about anti-avoidance provisions from a long time ago. This is a more recent one. And the Revenue have set out their guidance on the based on the outcome of that case in terms of the sorts of factors that they will look at when considering whether there is a business for incorporation relief purposes. And one of the factors there that was mentioned is spending more than 20 hours a week undertaking the sorts of activities that are indicative of a business. So managing tenants, looking after the properties and that kind of thing. But these are all looked at on a case-by-case basis. Now, historically, it would have been possible to go to HMRC for a non-statutory clearance to request their opinion as to whether a business was a qualifying business for incorporation relief purposes. But unfortunately, they no longer will give an opinion on that, on such a non-statutory clearance. So it is very much a case of looking at the legislation, looking at case law, and looking at the portfolio that you're considering. From a stamp duty land tax perspective, it is possible to avoid the liability there if you're transferring from a partnership to a limited company. That relief is not available for sole owners. And we also need to be careful of joint letting, because joint letting of itself isn't a partnership for these purposes. It needs to be I suppose in inverted commas, a proper partnership, partnership accounts, partnership agreements, partnership bank accounts, etc. All those factors to help establish that what you have in the first place is a partnership is helpful. I just wanted to mention that there are various schemes being marketed around incorporation, which very much proceed with caution. Some of these involve splitting beneficial ownership from legal ownership, which can not only have be questionable from a tax point of view, but also from a mortgage perspective as well, in terms of whether the lender will allow you to do that. So it's just to be proceed with care if you come across any of those types of arrangements. And just a general point, with the increase in corporation tax rate up to 25%, the actual maths about whether it's worth incorporating a property business leads us to conclude it's probably not as clear cut as it was a year ago, because the differential between the two is now less in terms of looking at the unincorporated business and an incorporated business. Of course, a whole host of factors there to think about in terms of profit extraction and all that kind of thing. But certainly, it's one where you just get the spreadsheet out and see whether it's worth doing or not. So that's all I wanted to cover off as far as capital allowances and property is concerned. I will now hand you over to Vicky, who will talk through the topic of private client matters. And logistically today, we're in the same room, so I'll just move to one side while Vicky takes my seat. Thank you.
Good afternoon, everyone. So I'm here to talk about private client matters, various different topics here that I'll run you through. So I thought it might be helpful to have a few date reminders for some deadlines or significant dates that are coming up over the next few months. So on the 2nd of October next week, HMRC's agent dedicated line, you may have read this in the press and their announcements, will actually remove the 10-minute service level time, and instead of having that, they'll inform callers of the expected waiting time. So I know that waiting times we found have actually been quite significantly longer than the 10 minutes. And so this will give you an expectation of how long you'll be on there and a choice as to whether to continue or not. They have also said that if you've got a PAYE query, the likelihood is that you'll need to choose that particular option and you'll actually be rerouted to a different advisor. And unfortunately, if you're wanting to discuss a few different topics, you might have to dial back in to talk about self-assessment matters separately to the PAYE ones. Then moving on a few days to the 5th of October, this is the deadline for telling HMRC if clients need to complete a tax return or not. And if they've not sent one before, because this is the way in which you can get allocated a UTR number. They have actually updated their guidance and provided some additional resources to use to check whether clients actually need to complete tax returns or not. And in their updated guidance, they have now excluded company directors from the list of examples where it's necessary to register by default for self-assessment without being self-employed. So that's a positive step and might help take out a few individuals from needing to do tax returns. Then on the 22nd of November, we've got the autumn statement, which will be interesting to hear what policies and announcements are outlined, and may well move forwards on some of the announcements that we've had on legislation day and in the spring budget earlier in the year. Then another reminder here, just that if you've got trusts, there are all additional things that need to be considered, and in particular the trust register itself. Now, this has a wide scope and catches both taxable and non-taxable trusts, although there are still some excluded trusts that aren't express trusts. So if you have a new trust that needs to be added to that, or you've got changes to key information on parties associated with trusts already on there, that should be done within 90 days of the change or the trustees becoming aware of the change. And don't forget also that where you've got taxable trusts that have to do tax returns, there's an annual declaration that needs to be done for all taxable trusts, and that should be completed by the 31st of January. And there's also a box on the tax return for the trusts indicating that this has been done. Now, going back to earlier in this month, on the 11th of September, after a short delay, the HMRC online form for submitting requests to get details for overlap relief was launched. There is further information on this and the scope of it and what information you'd need to supply within the most recent agent update that HMRC have produced. And obviously included in this is the fact that they can only give the details that are on their systems and which would have been provided to them in the past. but this should be a helpful resource for those of you that are looking at accounting dates at the moment in this year and seeing what the figures are that would be incorporated into those. So if you are looking to get those figures or have been waiting for this, it would be sensible to crack on and do that to see what information is available. Then moving on now to some campaigns that HMRC have been following over the last couple of months. The first one that I'm going to cover is one about gift holdover relief. Now, they have launched a one-to-many letter campaign, and this has been targeting taxpayers who made a gift holdover claim in their 2021-22 tax returns. So this is where there will have been claims to defer the payment of capital gains tax so that that's moved on to the recipient of the asset. Now, it says that these are being sent either because they did not submit the necessary claim form, so they didn't submit a copy of the holdover claim form, or the one that was submitted was unsigned by the donor and the recipient. There are certain circumstances where both the donor and the recipient don't actually have to sign the form, but that's where an asset is placed into a trust. And in those circumstances, it only has to be signed by the donor. Now, they've said that they've been sending out these letters from the end of August 2023. And within these letters, it indicates that there's 30 days to amend the tax returns or resubmit a completed form, and that failure to do so might result in HMRC amending the tax return or opening an inquiry. I'm not aware that we've received a copy of any of these letters or none of these have been shared with us, but I just thought it would be useful to tell you what's happening and to check that this is something that you're doing and making sure is done in a timely manner and submitted with the tax returns when you're doing them. So another thing that the Revenue are looking at is exceptional circumstances, and this flows through from the effects of COVID-19. So they are closely scrutinising claims that were made by non-UK resident taxpayers, saying that they were prevented from departing from the UK due to lockdown rules. Now, at the time of COVID, they did issue some announcements and some clarification that should hopefully have helped identify what were and were not exceptional circumstances. But obviously, exceptional circumstances, if they're allowed, could potentially prevent tax or as much tax being claimed by HMRC. So it's obviously a key area where they're looking to make sure that they feel the amounts included as exceptional circumstances are reasonable, that they flow through with what's allowed, and that they're not more than the 60 days that's permitted per tax year. So, as I say, they're making challenges to a number of exceptional circumstances claims, and examples of this are taxpayers making conscious decisions to remain in the UK during the pandemic rather than not having the option to leave, because for days to be exceptional in the UK, you have to have made every effort to leave at the first opportunity. They're also applying the benefit of hindsight when they're analysing intentions and actions. And as we'll all remember, there was a lot of uncertainty and confusion at the time when the lockdown rules were here. So it may not be that there's all of the paperwork there to support it, or that the evidence as clearly supports the intention to leave as soon as possible. Now, the Revenue do have an established team to look and review the UK lockdown rules and travel restrictions that were in place during the pandemic. So it is possible that your clients, if they've claimed exceptional circumstances, will have this looked at. And if you do get one of these letters, they are requesting significant information on this. So it could be quite a timely and time-consuming matter to move this forwards. Then another topic that I thought was interesting and brought home the impact of the freezing of tax rates and allowances is that the receipts for inheritance tax are increasing all the time. And in fact, between April and August this year, they've totaled 3.2 billion, which is £300 million higher than the same period last year. This, I think, highlights the importance of inheritance tax planning and the fact that opportunities to discuss this with clients would be sensible. It's likely to be a record-breaking year for inheritance tax receipts, and there's no sign that they're reducing. And it's impacted, as I say, by the continued freezing of bands thresholds, some of which haven't changed for a number of years since 2009 and are not set to even be looked at again until 2028 onwards. So thinking here of topics that could be considered, you know, lifetime planning, making use of tax efficient allowances, and making sure that clients have tax efficient wills as well. And associated with this is the fact that individuals have a nil rate band, and that does refresh every 7 years. And so there are strategies that people could use as appropriate, making sure that they keep enough assets to make sure they've got more than enough to be maintained into the future. But many, many families are now finding themselves caught in the IHT trap, where in the past they wouldn't have contemplated that they would have been. So another item that links into inheritance tax is the fact that pension changes, it's been announced, do actually have an unforeseen and unexpected and disadvantageous impact on the under 75s. The draft finance bill announced that there was a disadvantage associated with what had been seen as a very positive step, that they'd abolished the lifetime allowance. And with this, there's the proposed introduction of an income tax charge on inherited pensions. So just to put this into context, since 2015, there's been the ability for individuals who die under the age of 75 to pass undrawn pension funds to their dependents free of inheritance tax and also income tax charges. And this has been an important planning measure for those whose circumstances allowed them to do this. The abolition of the pensions lifetime allowance, as I've said, is a welcome relaxation, but there will, unfortunately, it seems, be a restriction on the ability of dependents to inherit undrawn pension funds free of income tax from the 6th of April 2024. So this is only April next year. In the paperwork that's been announced and the draft legislation, it's indicated that dependents will in future be subject to income tax at their marginal income tax rates on amounts that they're received from a flexi access drawdown pension or annuities, unless the amount that they could inherit is taken as a cash lump sum. But if it's taken as a cash lump sum, whilst it is possible to have a significant amount of that tax-free, for example, under the lump sum death benefits allowance, which is up to a maximum of 1.073 million, where the deceased member hasn't used it themselves, there will still be income tax due on the excess. And taking the lump sum loses the opportunity to enjoy the continued tax-free growth within the pension wrapper. And it also removes the ability to pass on any remaining funds tax-free on their death under the age of 75. So there are significant disadvantages. And this is something that the institutes and people have been commenting on and asking for clarification. So it would be sensible to monitor this, but it would be a significant disadvantage. One final topic that I wanted to mention is that Legislation Day 2023 gave some additional information on the geographical restriction on inheritance tax release that was announced in the spring budget. In the budget, it announced the scope of agricultural property relief and woodlands relief would be restricted for inheritance tax purposes, and that relief will only be available for property in the UK itself. So amendments in the draft finance bill will have effect for any transfers made on or after the 6th of April 2024. So just to expand on this, any estates where the death happens before the 6th of April 2024 and where the deceased held agricultural property situated in the EEA, the Channel Islands or the Isle of Man will qualify for agricultural property relief, and similarly for woodlands relief. If there's any deaths after that date where these assets are held, unfortunately, they wouldn't qualify for agricultural property relief or woodlands relief, and so the inheritance tax due will be larger. Where the transfer of value happens before the 6th of April 2024, this is potentially more complicated and would be affected by whether the individual making that gift survives 7 years or not. If the transferor fails to survive the 7-year PET period after that, the position would be retested on death under the IHT clawback provisions. So for a death on or after the 6th of April 2024, property situated in the EEA, the Channel Islands, or the Isle of Man would no longer qualify for agricultural property relief. And therefore, inheritance tax may arise on a failed pet, or there could be additional inheritance tax due on a chargeable lifetime transfer into a trust. So where lifetime gifts are being contemplated, then it would be sensible to do these before the 6th of April 2024 to capture the relevant relief, but warnings should be given to clients in respect of the total loss of this relief in the case of a death within 7 years of the gift after the 6th of April. Where trustees have had the benefit of agricultural property relief on assets at a previous 10-year charge, then thought should be given to whether these assets should be distributed to take advantage of the reduction in the rate before the next 10-year charge, when the benefit of agricultural property will be lost. And also, all trustees holding assets that fall into these categories should consider whether they should be distributed before the 6th of April 2024, when the benefit of agricultural property will be lost. Obviously, you'll appreciate that this presentation is being driven by the tax consequences and is only giving high-level thoughts, and there are obviously practical and more wider implications from distributing assets from a trust. But I hope that these examples help show that if you've got any individuals that have agricultural property in those locations, it is something that they should have on their radar and to consider carefully. So thank you for listening, and I'll now pass on to Paul, who's going to talk you through some items within tax investigations and inquiries. Thank you, Paul.
Good afternoon, everybody. I've selected a couple of topics for some minutes coverage in this session as regards tax investigations and inquiries. The first one is what's known as the tax gap. Now, from time to time, the tax gap surfaces in the professional and technical press with a little bit of commentary, and then it goes quiet, and then it resurfaces. But when we look at it into it in a little bit of detail, we'll see it will actually become a little bit more under focus for reasons we'll see in a second. But to begin with, what actually is it? Well, quite simply, it's the difference between what HM Revenue and Customs expect that the total tax take for the year should be when compared to what is actually received for that same year. You might think the two should be more or less the same, but the reality is there is a difference, there is a divergence. And the most recent information was published 3 months ago by HMRC for the year 2021-22. So, what does it show? The Institute of Chartered Accountants in England and Wales, the tax faculties, had a review of the content of this, and there is also information on the gov.uk website. But what I wanted to do is just talk through a few topics where 2 points on this topic where I think we will start to see increasing activity. So, if we bear in mind that the total, in macro terms, so to speak, of all tax that is or should be collected is around £730 billion per annum, what does it mean when we start to boil these figures down? Whilst in percentage terms, the gap between what has been received as against what should have been received in the Exchequer has held steady at just under 5%. In real terms, though, in monetary terms, it's increased by £5 billion to now £36 billion. Now, that's becoming quite a significant amount of money, plainly. So what does this tell us, and what likely revenue and customs and activity are we going to see? Because the government puts pressure on the Treasury to collect and narrow down this gap. And it focuses then as to where will HMRC focus their attention. And when we look into the commentaries within this gap, they are stratified in one sense by what HMRC refer to as their customer group. And it's the small business share which is becoming interesting, which has increased to now over 50%. Now, if you think, if we said that the tax gap sits at around 36 billion, this means that the small business share is now around 20 billion per annum. Interestingly, individuals and wealthy, that particular group that HMRC categorised, it's a relatively low proportion of the gap, in total around 11%. So bearing in mind what we see about the small business share increasing, what will we anticipate future HMRC activity to be? Inevitably, there will be a heightened focus in the small business arena. The statistics go that dawn raids, now fortunately, I'm trying to remember when I last saw a dawn raid, it was many, many years ago, but they do exist and they are increasing by 9%, so the figures show. But more to the point though, what are we looking at areas where HMRC will focus their attention? And this is a particular area that now HMRC are going to identify as an area for scrutiny and further investigation and inquiry. This is the area of what they've called sales suppression tools. And following a raid to the major provider of that software in 2022, HMRC obtained a list of customers who had signed up to the acquisition of this tool. And what it does is, it provides software which, when loaded onto the purchaser's card readers, it diverts a percentage of sales away from the business's records. And that has long been a way, if businesses were determined to suppress their income for tax purposes, they would do. But this is becoming more sophisticated now. And the data that HMRC now hold will enable them to look further into this without having to do calculations more manually, as was previously the case. They've called this, which is prevalent in the small retailers and restaurants sections, so-called zappers. So if you come across that wording, you now know what it relates to. But I mention this because there are many cases where small retailers and restaurants feature in practitioners' portfolios. And if you do have any of these clients who may, unbeknownst to you, have been tempted to acquire this particular piece of software. And it would be well worth highlighting now that HMRC has this data, and it will almost certainly be following it up sooner rather than later. The second area that I want to look at is this ongoing HMRC nudge letters campaign. Vicky mentioned it in the private client session. This has been a device, so to speak, that HMRC has been carrying out for the last 3 to 4 years or so now. And it's really designed to, with the minimum amount of effort and manpower put in by HMRC, to instill and nudge taxpayers or potential taxpayers to make a disclosure by way of reviewing their own tax affairs to see whether, in the cold light of day, everything that should have been returned for tax purposes has been. For example, we have in previous sessions referred to particular focused targeted areas like the Euro-Pacific Bank in Puerto Rico, where there were 600 or so UK residents who held accounts in that particular bank. HMRC received information as to who those 600 individuals were. And by simply putting together a very generic letter and matching it up with the names and addresses of those individuals, out went that particular nudge letter, which basically says, you may not have returned everything to HMRC that you should have done. Would you care to have a fresh look and let us know? And they're as bland and as generic as that, but they are working very, very effectively. So what is the latest targeted activity for these nudge letters? This one is known as persons with significant control. Now, you will all be familiar that all corporates are listed at Companies House. And within that data for those companies are the shareholders. And if those shareholders have typically a greater than 25% holding in the share capital, the equity capital typically, then they come within this persons with significant control. And HMRC have identified a figure, they've set the figure for some reason, and it isn't clear why, at a figure of £100,000 for income that HMRC thinks perhaps individuals shown in companies' records should be returning and haven't on their own tax returns, or indeed they haven't declared any income at all. But what HMRC are doing is saying, well, in companies' house records, there are these individuals who, on the face of it, have underdeclared or not declared at all income that they should have done in the UK tax system. Now, bearing in mind that these are very general approaches, but they are becoming quite effective. I say general because, as an illustration, if you bear in mind that not all shareholdings, as shown in companies' house records, are beneficially held, they may be held on behalf of, for example, trustees holding shareholdings on behalf of beneficiaries. Now, that level of information will not be shown on companies' house. So HMRC won't necessarily know about that particular matter, but it doesn't stop them matching up this data with a very general type of letter, identifying these individuals. Out go these letters, 1,800 or so nudge letters targeted at this group, all part of what HMRC call their educational program to help individuals understand their obligations. Now, what the letter as regards those individuals it has identified that it can see have already submitted a 21-22 tax return, what that letter says in its wording is that, is there something that should have been declared and hasn't been declared? So the tax return has gone in for these categories of individuals. And HMRC are nudging those individuals to have a fresh look and a fresh think to see whether actually, in the cold light of day, something has been omitted for whatever reason from that tax return. And HMRC have asked for that correction to be done by the 18th of last month. Now, okay, that's historic, but so what? There's no actual basis for that date of the 18th of August. From the narrative in the professional press that I've seen, nobody can identify why HMRC have set that particular date. So largely speaking, that can be ignored. More importantly, the requirement to amend a tax return for 21-22 is by this coming 31st of January, and that's far more significant. So if there are any corrections to be done, then they need to be done in the next few months by the 31st of January in that set of circumstances. Now, whether that in turn will give rise to further inquiry from HMRC, we'll see in due course. But that's the requirement as things stand. Now, for those individuals identified by HMRC within companies' house records, who HMRC cannot in turn locate a self-assessment tax return for, as filed or not filed in this case with HMRC, then the phrasing of this particular category of letter is basically suggesting to those individual recipients of the letter that actually you might or should be now registering for self-assessment and submit a tax return for 21-22. Plainly, that's for an earlier year, and it does mean that the category of this type of taxpayer is more likely to get some sort of HMRC compliance check with possibly, quite likely, higher penalties arising. It's interesting to see that HMRC are serious about this to the extent that they have set up a separate email address, wealthy, OTM as in one to many, so wealthyotm@hmrc.gov.uk. This is another form of nudge letter that is now being sent out by HMRC. Now, this one is addressed and sent out to agents not to the client, not to the taxpayer as such, but to the tax agent. What HMRC are doing and have done in this set of circumstances is to send out letters last month relating to SA returns for 21-22, wherein there were one or more provisional figures in those particular clients' tax returns. Now, bearing in mind this letter is going out to the tax agent, not to the client, what the way these are worded, what the agent is going to have to do, if they have several of these cases, I mean, exceptionally, on occasion, the agent is left with no alternative than to put a provisional figure in a return. It's to be avoided if at all possible for obvious reasons, but just now and again, it may need to arise. And if there are several of those clients, then it means that the agent is going to have to go through the list, because the letter sent to the agent does not name the clients to which the letter is aimed, if you like. Although apparently, if the agent does contact HMRC will give them the names and the UTRs of those clients, but the onus again is on the agent to do so. The request by HMRC in this situation is, if final figures now are readily available, then to do so, to put the amendment to finalise the return by the 30th of November. Whereas even if all the final figures haven't been yet obtained, then wherever possible to do so by the 31st of December. Now you might say, well, what about the 31st of January coming up? Because that's still the deadline. But you have to smile wryly to yourself when HMRC say that the reason that they've put these dates in, the 30th of November and the 31st of December, is because it recognises the heavy workload of tax agents in the month of January, as will be January next year. Bear in mind that whilst these letters do have a significance, there is no statutory basis to them. Those deadlines are not statutory. No obligation to meet them. Plainly, it makes professionals' lives easier if they can. And the request also has no statutory backing. So there is no legal basis to this correspondence. The but there is, if these matters are still held open, it will enable HMRC certainly to consider raising a line of inquiry in due course. And plainly, as advisors and agents, we want to avoid that if we possibly can. And there we are.
Thank you, Paul, and thank you also to Vicky. Again, some very pertinent and interesting information there, I think, from everybody. So thank you for that, and hope everybody got something out of that session. Looking at the question and answers, just something that's coming separately, just a point of clarification around property businesses. If you have an overseas property business, that is treated as a separate business for losses purposes. So you can't set losses of an overseas property business up against profits of a UK property business. Just to clarify that particular point. And just see if there's anything else that's come in. No questions there. So yeah, just leads me to say thank you again for attending. We are planning to do one more webinar this year in December. Timing wise, it probably works out quite well in that, as Vicky mentioned, the autumn statement is on the 22nd of November. So probably the first week in December we'll be running this again, picking up anything of interest coming out of that autumn statement, but also, as always, any other things that we think are topical that you might find of interest. As always, let us know if there are any topics or areas that you would like us to cover. We're always happy to do that. So just drop us an email and let us know. And that's it then. Thank you very much, and we will see you in December. Thank you.